Okay, if I've got the instructions right, it's showtime. Hello, everybody. My name is Bob Eccles. I'm a professor at the Saïd Business School at Oxford University. I'd like to quickly introduce my panel. They can tell you more about their backgrounds. Kind of from my right, we'll go in this order, is my good friend Desiree Fixler, who was at DWS, and there's a story on that we'll get into. We have Melanie Adams, who is head of corporate governance and responsible investment at RBC Asset Management, and then my friend Jason Jay at the Sloan School at MIT. It's interesting. I listened to the panel that came before this, and this is going to be quite different. Like the panel before, I mean, it was like this real stuff, man. There was like value stacks and electrons and land and investing and windmills and hydrogen and fusion. It was like all these things we can kind of touch, sort of. This panel is ESG, corporate savior or greenwashing, and we're going to be followed by a panel on impact, having impact, investing in impact. It's interesting. I was on a panel earlier this morning. There's actually within this narrow community, growing community, ESG, impact, sustainability, same things are different. I think it's part of what we want to get into here. So obviously what's happening is that there's a lot of money that's kind of moving in the direction of trying to deal with issues around climate change. And the question is really, how authentic is that? And you see funds being raised, and they could be, ETFs, and they could be active management funds. And these labels are growing, and people talk a lot about how much money is moving into sustainable investing or impact investing, without these terms being defined all that well. And we have a good test case to begin with, where there was an asset manager that was making some rather bold claims about what their products were, and Desiree Fixler was there at the time. And so, Desiree, maybe we could get you to kick us off here. How do you see this domain between all this ESG stuff, trying to direct it to climate? How much of this is real, and how much of this is basically just marketing and greenwashing?
Well, look, I'm going to start off like with a positive statement. I think for the most part, the intentions are good. Right? We've successfully mobilized trillions of dollars into ESG strategies with, I think, most intentions were the right intentions. But to your question, has it made an impact? Not really, no. And so, you've got a situation where, everyone thought when ESG investing really skyrocketed during, COVID, that if you have an ESG label on a product, that's a quick win. And ESG means a lot to different people. So ESG runs the gamut, as you know, from risk management, negative selection, positive selection, to actually impact. And in the impact space, that's actually where we failed, and that's where we have to work harder. We need to mobilize this money into strategies that actually produce clean technology, that actually in the investments, right, with double materiality, actually have and affect social justice. So to answer you, no, there hasn't. We haven't done much at this point.
So if I could ask you just a little follow-up question for our audience, if some people that may be new to this a little bit, what is the difference between ESG and impact in your view? Because you made that distinction. I think it's a really fundamental one.
I think, well, when I hear ESG, it's everything from starting out to say, okay, the world is changing, right? There are new risk factors when it comes to investment, or when it comes from operationally running my company. And these new risk factors are everything from, climate, physical and transition risk, technological changes, consumer preference changes, regulatory changes. And how do I position my company or my investment actually as a winner here from a risk-adjusted return standpoint? That's what is known as ESG integration, or in integrating ESG criteria, risk and opportunity factors into your investment process. But then it moves on, right? Then you can also, add on a level of values, right? Not only is it about how the outside world affects company, but how your investment or your company affects the outside world. So the impact, right? So you can move into positive selection, right? Building portfolios that are best in class to benefit from this changing world. to finally what is considered positive, like high developmental positive impact. With such strategies, it could be, off-grid clean technology, energy access in, less developing countries, right? It could be, financial inclusion, healthcare, education as examples.
One more quick question. I'm going to turn it over to Melanie. So when you look inside, like what the asset management community is doing, how much clarity do you think asset managers have between when they're putting a fund together that's doing the ESG integration you're talking about, and a lot of that is risk management, versus this is a fund that was consciously constructed to have positive impact, in this case, say, to deal with climate change? Are those concepts clear in fund construction in the asset management community or not?
Well, I think, Bob, we worked together on this 7 principles of ESG investing, and I think we tried to address some of these issues. And, certain platforms and certain fund products, yes, they get it right, and others they don't. When you've got ESG teams sitting aside, an island unto itself, exposing values that the portfolio managers haven't signed up for and haven't integrated, there is a disconnect. You also have, at times, right, in some firms where marketing, dominates. And again, the product might be an investment in best-in-class companies that actually the objective is not to do good in the world, but actually optimize risk-adjusted returns, but it's labeled as climate action or sustainable development goal oriented, as an example. So it really depends on your fund manager. The onus is on both asset manager to fully disclose, right, everything, verifiable metrics, objectives, data sources, to obviously investor. Unfortunately, there's a lot of work for investors to kick the tires and ask these questions to ensure that's all aligned.
So, Melanie, you're an asset manager. So you could be the culprit or you could be the good guy in this whole thing. I mean, how do you folks think about all this?
Well, I think Desiree did a good job actually of talking about the value versus the values, because I think what we need to do as an asset manager, and certainly at RBC GM, we're always thinking about this, is the mandate that we're given by the client. We have a fiduciary duty to our client to invest in the way that they have asked us to invest in that. And so there is the risk area, and in thinking about ESG integration, and you're incorporating that into your investment process because you think it might help improve your risk-adjusted returns. This is our philosophy, and this is what we do at GAM. All of our investment teams look at ESG factors as part of their process. It is a documented part of their process. It's systematic. They do it. It's material ESG factors. And that's really important. And we're doing that for the risk-adjusted returns. It might help, and that's why we do it. But there is also this area where you get into the values, where you can start screening out certain sectors, certain companies based on product involvement, and then, of course, you can go into impact. And when you go into those areas where you're going beyond looking after the risk-adjusted returns of the portfolio, we need to be really clear about that in the prospectuses, in any of the documentation, the marketing materials that are put out there, really clear about what potentially is being excluded, the impact on the investable universe, any other impacts on the fund. And if it's impact, if the fund is intending to drive change, that needs to be clear as well, and how the fund is doing that and what that looks like. And so from the asset manager perspective, there's certainly a lot of work in making sure that there is this type of clarity about that. And we're seeing a lot of help in the terms of regulations in different regions. Certainly Europe, it's quite a lot of regulations in that area. We're seeing that both as well in Canada and the US, a little bit different, a little bit less prescriptive in North America, but it is coming, and that's helping. It's going to help the end client, the end investor, really understand what this means. It can be really confusing. There is ESG integration for risk, and there's ESG integration for values, and how do these work together? And it's challenging sometimes for the client to work through that. And so it is up to asset managers to be clear about what they're doing and what that means for their investment products.
So let me ask you a following question. There's all this talk about these net zero alliances. There's the net zero asset owners, net zero asset managers, net zero this and that and the other thing, and GFANs. To what extent do you have institutional clients that are asking you to construct net zero portfolios by some date? Is that coming up a lot?
That's a great question. It is starting to come up more and more, especially from our European clients who are looking for that type of a portfolio. There's different ways to do that and different ways to think about it. You can look at the actual emissions of the portfolio and reducing the emissions of the portfolio. You can also look at what issuers are in the portfolio and which issuers have made their own net zero commitment, and is that credible? And so you can look at it as a percentage of the issuers. And so there's different ways to look at it, to think about it, and it depends on what the client's looking for. But ultimately, I think what is really important to be clear about is that there's data gaps. So no matter which methodology you're looking at, you're not looking at a perfect answer, a perfect solution, or this is the exact emissions. We still have, big gaps in fixed income in particular, small mid-cap companies, we don't have that data. And so being really clear and honest with clients about that, we won't carbon footprint for a client if there's less than 65% coverage. It's just not meaningful. And so being really, I think we need honesty and transparency about what this data really means, so that we're not overselling what it is or what the fund is doing and able to do.
Well, and the data is a big problem. I mean, we won't get into the weeds on that, but that's what this International Sustainability Standards Board is trying to address, in the EU with its corporate, sustainability reporting directive, so that, we have metrics on carbon emissions like we've got for revenue recognition, so that the data is reasonably good. And in the EU, the SFDR, I mean, it needs data to sort of really know, I think, credibly whether these are Article 8 or Article 9 funds. Let me ask you one more question. I'm going to turn over to Jason. It's something that Jason, I think, can follow up on. So here's my sense, my cynical sense of some of these asset owners. They go, you know what? I want a net zero portfolio, and I'm not going to give up any return, so go figure it out. All right. And then the big question becomes, do you divest or not to get your portfolio to net zero? How do you handle that? What if your client tells you, let's start with the easier case, maybe, divest if you have to, but I still want the returns. Then what do you do? Because it's fashionable to divest. I'm cynical about it, as you can tell, but you've got to deal with it in real life. How do you folks deal with that?
Well, we have to be honest. If you want to divest from a certain sector industry, if you want to divest from fossil fuels, there might be implications to doing that. And clients need to understand what that means. So, we've seen recently that there would be implications. And so understanding how they're shrinking the investable universe when they do that, or when they're trying to get to net zero, what are the pitfalls? What does the mandate look like? And making sure that it's really clear. Because I think right now we're not at a stage where you can definitively say, yeah, you can get to net zero and there won't be implications on returns. There may not be implications on returns. That depends on the actual portfolio itself. If the portfolio itself isn't really invested in some of these high carbon sectors to begin with, you might have less of an impact and you might be okay. But that's not going to be the case in many portfolios. And so I think having your cake and eating it too is a challenging part of this. So I think for us, we're just very transparent about it, what we can and what we can't do, what the reporting means, and making sure that when we structure our mandates with our clients, that it's very clearly laid out.
Jason, let me let you jump in here.
Yeah, look, I think the distinction that Desiree made between kind of a risk approach or risk return maximizing approach and an impact approach is really important, and very closely related to that is the distinction between actions that are about moving capital around versus actions that are about using your ownership power. So I just want to get something clear, which is that buying and selling stocks in the public equity markets doesn't change anything about the actual world. Right? It's that's to the extent that divestment by a highly symbolic institution like the Rockefeller Fund or the Harvard Endowment might have some political effects for MIT, right? But the reality is, and Julian Coble did this fantastic paper on, can sustainable investing save the world, where he systematically reviewed all the evidence on this, and the evidence base is just much, much, much stronger for shareholder engagement, active ownership, and active shareholder engagement as a route to change the real world, where tilting portfolios with ESG data or divesting from certain sectors or companies doesn't really have an impact in the world. It might make you feel good. It might make you Bill Gates in his climate book talks about this. He says, look, I know that divesting from fossil fuels isn't going to change anything in the world, but I don't want to be the kind of person who benefits when pollution is happening. So I divested our Gates Foundation portfolio of fossil fuels. And I think that's a really good articulation of this sort of virtue ethics idea behind I want to get out of these things. But it doesn't change the world. What does change the world is engine number one, buying 0.02% of Exxon stock, mobilizing a bunch of other investors behind it, and placing 3 new board members on the corporate governance who are potentially going to drive new conversations in that company on climate strategy. What changes the world is the Climate Action 100, which is a coalition of investors who have identified the 100 most emitting companies. They're deciding to own those companies, and they're deciding to use their shareholder power to try to drive greater disclosure, more ambitious target setting, and more careful management and governance of those targets to ensure that they actually are achieved. And if we want to talk about impact, that's how we're going to have impact through these kinds of public equity markets. And I think what's the good news about that is that it also allows you to skirt some of the issues that Melanie was raising about how if you constrain your portfolio universe, you might not optimize return and so on. You can actually get away from all of those questions and say, look, we're going to own a portfolio that maximizes risk return, but then we're going to be active owners to drive toward decarbonization. And I think that's a strategy that we need to understand is legitimate and not, see as some sort of, if we only think divestment is the only way to act on this, like we're going to miss that opportunity to really make change in the physical world, the stuff that they were talking about in the last panel.
The real panel that was in the real world of electrons and land and windmills and stuff like that, and value stacks. That was really exciting. I was really to be able to hear some of that. So look, I agree with you. Let me just, as an aside, say I'm a little bit cynical about Bill Gates. So it's like, I get what he said, and that's fine. But, oh, wait, Mr. Gates, you're the one that was one of the largest shareholders in Berkshire Hathaway that didn't vote for the shareholder proposal to have a modest, reporting of carbon for the whole portfolio of the Berkshire Hathaway companies for completely bullshit reasons, that they sort of put, in their responses, like, give me a break, right? I mean, why don't you vote your votes? To kind of walk the talk. I mean, we're just saying do a little bit of carbon reporting for Berkshire Hathaway, but let me let that go now. Let me ask you guys.
I think that's exactly the problem, right? People don't understand, and all of us forsake our ownership, right? We've got a zombie capitalism situation going on here where, my retirement assets are, with our Fidelity 401k thing, I've delegated my voting ability to Fidelity. They've delegated to Vanguard that manages the fund. Vanguard has delegated to ISS, who's defined some generic shareholder policy, who has constructed that voting policy based on what they think the general investor wants, and nobody's actually in charge. So I think the whole key in this space is really waking everybody up to our responsibilities as owners and the opportunity that we have to try to drive a real transition.
So here's something that's puzzling me. It's probably not what we're supposed to talk about in this webinar, but Josh isn't here, so we can't do anything about it. So we can talk about whatever we want. I had lunch with a woman from Reuters on Monday who covers activist hedge funds, right? And as you know, I know the engine number one situation really well because I know the people at engine number one at CalSTRS. And I talked to Chris James, and he's like, well, who else is out there? Like, we're trying to raise money. That was a very particular situation. It was like basically they did all the heavy lifting, and they needed the asset managers to come in. So what do we need to do to get more kind of what CalSTRS would say is activist stewardship? It's not something that the RBCs of the world will do, but, unless, and you don't need a dozen, right? Maybe it's a dozen, not 100. What do you think it would take to get sort of much more more examples of the engine number one. That was a big wake-up call for the oil and gas industry. How do we get more kind of activist hedge funds taking that approach that engine number one did, so that then people like, Melanie can kind of weigh in and cast their votes to make it happen? Because there's a huge heavy lift that's got to be done in the first place. And I just don't see the capacity being built out there.
I mean, one thing I'll throw out there that in a starting point, I'm sure you guys would say the same thing. It's really the might of, and you brought it up, CalSTRS, the might of the institutional investor community, right? So I think that's very important. In addition to, just general activism. I mean, we saw meaningful change on Wall Street, right? Some folks look at Occupy Wall Street and say like, oh, not that much change. I think it was really meaningful having been in the derivatives and the structured finance, structured credit space. I mean, we always talk about pre and post, GFC. So, I think this type of activism and, coming from, investor demand, in particular here, I'd say the pension funds and insurance companies, that's really meaningful. The other point to make is we all have to just accept that there has to be legislative change, right? That governments need to act here, right? I'm a big believer in the capital markets and the power and the might of the capital markets, but we need further guardrails. We need the public sector to come in. We need to price in these harmful externalities so that the capital markets can make better choices. That's the other thing that I would add in here, is that in addition to, investors, demanding more corporate engagement, to change, with their votes, with their positions, to change companies, we also need governments stepping in, and we ourselves in the financial community need to work well with the public sector and not lobby against it. We have to be part of it and ensure that it can be executed in a sensible manner.
Well, and ensure that our portfolio companies aren't lobbying against climate policy. Right. So, I mean, Amy Meyer is doing fantastic work at the World Resource Institute, WRI, illuminating, what is a responsible lobbying kind of approach look like around climate. And, when I've talked to some heads of stewardship for asset managers, they're writing letters to companies saying, what are you doing on, why are you saying with your sustainability report that we're going to reduce emissions, go net zero, but then you're giving money to this this politician who is opposing any kind of carbon legislation? We can't have that kind of duplicity. And that's, I think, one of the important frontiers in ESG measurement is actually the measurement of companies' corporate political activity with respect to some of these critical ESG issues. And I think that's a very hot topic in this area. And it's something where, because we're not going to solve this problem without a price on carbon, and a whole bunch of other interventions. You can take a look at our En-ROAD simulation tool to kind of play with that. And so any barriers that we're putting up in the private sector to that happening, we need to remove immediately.
So look, I'd like to agree with you, Desiree, about regulation being important, but let me try to get you back down to reality, because you haven't been living in this country for a while. So let me kind of get you up to speed on the situation here, since you've been over there in Europe. That asshole attorney general in West Virginia said if the SEC comes out with any kind of guidance around carbon reporting, he's going to sue their ass. And I'm thinking, okay, now that's really an evolved thing. So you've got the SEC struggling to come out with some high level principles, just on carbon. So let's go to the even hotter button issue that Jason, you raised. Big debate. And I remember this from the early days of SASB. Ask each one of you, do you think political lobbying from the perspective of, say, the ISSB, is political lobbying a material issue that companies should be reporting on?
Yes, 100%. Without a doubt. Without a doubt. But I would say this, I'm going to give the SEC a little bit more credit, right? We have a change in administration. We have a change in leadership at the SEC. And the SEC is laser focused on investor protection, right? So you've got Europe that largely, the European Union Sustainable Finance Action Plan is largely around mobilizing money into sustainable investments, and it is considered ahead of the US. That said, the US is wonderful when it comes to that concept of gradually then suddenly, right? And when the US moves, I mean, it's a big country, it's a pretty powerful country, it's big capital markets, it does it in a meaningful manner. And I do think that the SEC is trying to get this right. There might be some asshole in like West Virginia, but generally, right, corporate America, because it is about investor protection, kind of in two areas. Number one is to ensure that companies are fairly disclosing all risks, right? And the second one is that we're not misrepresenting. Companies aren't misrepresenting what they're doing. Asset managers aren't misrepresenting. And I think that Gary Gensler and the SEC is laser focused there, and they're taking their time to get this right and also not overdo it so that it is very much enforceable. You don't want a situation, sometimes Europe gets themselves in these jams, where it's overregulated and it's actually easy to game it. It's easy to tick boxes, right? It's easy to take a product that has no impact and label it Article 9. It is so easy to game that right now there. Here, I think what they're trying to do is being more meaningful, where you're less able, as a company and as an asset manager to game things.
So I think you're right about the SEC. Go ahead, Melanie.
Oh, I was just going to say that, just commenting on Desiree's point, because I think that's right. And I think what the SEC is looking at, and this is the case in Canada as well, is more transparency. And they're looking at companies, which I think is the right order, because it's difficult for asset managers to provide all this data on the funds if it's not out there on the companies themselves. And we're finding ourselves in a bit of this situation in Europe where there's a lot of regulation coming at the asset managers, and we don't have the appropriate data. And so we're beholden to these third-party vendors to provide it so that we can meet our regulatory obligations. And I think the right approach is, what Desiree has spoken about, which is this focus on the companies and providing that transparency right at step one. So then we can push it down the value chain that it's correct, and then it becomes more meaningful for the end user and for clients.
And that might also help with the coverage issues that you raised earlier, Melanie, that, we have ESG data only from a subset of big companies that have been in the limelight, but more regulatory mandates for disclosure might deepen that pool of firms with data.
And they could conceivably cover private companies. I mean, the EU taxonomy and the CSRD covers it, and it's conceivable that it could come out with the SEC. But I agree with you, Desiree. I think they're doing a very good and careful job. And I had an interesting interpretation of it in a conversation I had the other day with a friend of mine who's at George Mason University. So, man, I got friends on the right, and I got friends in Extinction Rebellion and activist hedge funds. And obviously, we have some different views on things. But he made a very interesting point. He said, look, what's going to happen, it's going to be like Sarbanes-Oxley. It's going to be very clear that you have to sort of say you've got these internal controls and report on it, but they're not going to tell you how you have to do it. And then I think what's going to happen, the point you're making, Desiree, there's a lot of big companies here. It's a big market. My guess is the fallback position for U.S. companies is going to be to use the ISSB, climate disclosure standard that's going to come out, because the SEC is going to say have to do it. They're not going to tell you how, and then they're going to use this, and then it's going to be how does that reconcile with the CSRD? Here's a different question. It's so general, it's almost meaningless, but we're coming to the end of the time, so we can get into these existential issues. Do you think there's more greenwashing in the corporate community or the investment community?
Oh, okay. Listen, that's a really fair question, a really big question. I don't know. I would just say that everyone from 16 onwards understood it was a benefit to use sustainability rhetoric, if you will, make statements. And then over, COVID, it just skyrocketed. I think a lot of companies really are trying, right? It's a long-term commitment. It takes a lot of resources. You have to be really honest, right? As Melanie said earlier, as we're all saying, we have incomplete data sets, right? It's just an imperfect world, right? So don't make these other statements ESG is in our corporate DNA. It's at the core of everything we do, right? It's just not yet. And so whether it's the investment community or corporations, now I'm going to be glib myself and saying, like, just scale down this propaganda and rhetoric, and just scale up collective action, right? Or individual action as well. And just try and, work to get this right and to complete data sets and to jump in and support ISSB. I think this is most meaningful, what you've just raised, right? We need standardization here, and that will be most helpful, right? Whether it's from a regulatory point of view, or it's for mobilizing money in the capital markets.
So
I think greenwashing.
Go ahead, please. Go ahead.
Greenwashing too is a term that I haven't seen any bad intent about. We want to oversell or we want to greenwash, and certainly we're very careful at our firm about that. But from companies and so on, it's just ill-defined. And we need, once we have that standardization and once we have some regulation around it, it will go a long way to ensuring that that the good intentions are appropriately directed.
And one last comment to make, I do think that, just like in the, during, or after the financial crisis, right? An enforcement action or enforcement actions generally leads to better, like, market-wide practice.
The wake-up call.
Nothing that gets that Wall Street gives more attention is if, like, the dude sitting next to you just got busted for XYZ for mis-selling in some context. So what I mean is that I think that we will see meaningful change if there is some regulatory action or enforcement. It captures everyone's attention, and it makes sure that folks completely understand that they have to be as accurate on their non-financial reporting as they do on their financial reporting.
So here's some good news. I learned how to use WhatsApp this morning because they told me the questions were going to come in on WhatsApp. I'd never heard of WhatsApp before. And then I found it online and I learned how to download it on my phone. So I've got the questions. We've got some good questions. First one is from Scott McMeekin. Views on the state and importance of green taxonomies and what must happen to make them effective. Can different markets have their own taxonomies, be globally aligned? It's a great question because that's really the thrust of what's happening in the EU. China's thinking about their own. Who wants to pick that up? Kind of how important are green taxonomies for the issues we've been talking about, moving capital and making the world a better place? Who wants to take that one?
I can start and say I think that there's a really important role for green taxonomies, especially if you're thinking about building investment products that you want to line up against the taxonomy. It helps clear up some of these gray zones. The big issue is that we can't seem to resolve some of those gray zones in the various jurisdictions. Nuclear being a big one in Europe. But I think if we could get there, it helps set some parameters around what we're doing in terms of and how we're promoting and how we're discussing investment products, if they're lined up with the EU taxonomy or not. It gives some guardrails, but I would be cautious about it being the only solution, depending on how you're looking to invest. And this goes back to the values conversation. If you're looking to invest in a certain way, you've got to be careful that maybe that taxonomy isn't exactly that way, and you've got to make sure that what you're investing in is in line with what you're looking for. And so it creates a potential to oversimplify, I think.
But the nuclear thing is interesting because that's where the value and values thing gets all muddled. I mean, there's people that make the argument we can't get to net zero without nuclear. Jason, sorry, go ahead.
Yeah, no, absolutely. I like that. I like the taxonomy thing and that it gives people a ladder to climb. Like I've talked to asset managers who are like, oh, we got categorized as Article 6, but we're going to change our practices so that we can get upgraded to Article 5, right? And I think that's I think any time where we sort of create those sorts of clear expectations and ladders, that's probably going to nudge people in the right direction. But to Melanie's point, what constitutes that ladder? And is it in particular, is it this kind of virtue lens or the impact lens? So is going up the ladder mean that I don't include the emitting companies? Or does it mean that I include the emitting companies, but I more aggressively shareholder engage and vote to change them? And I think that distinction is really essential for this. And so the taxonomies may be meaningless if they're only based on having purity as the top of the ladder, because they won't actually change anything in the real world.
So there's another question that's interesting. I'm going to target you, Melanie, because you have to make real investment decisions. To what extent is there concern over a carbon bubble factoring into asset managers' investment decisions? So do you think there's a carbon bubble and carbon reduction stuff is overpriced and carbon emitting stuff is underpriced? Like, what's your view on the carbon bubble?
Well, I think that there's certainly some question about, well, we need to see more carbon markets globally to do anything about this. And we're seeing some products in line with looking at those carbon markets and being able to invest in that. I think that there could be, and it's different for different markets, can be regional based, but there's a lot. I mean, it's an unknown world out there right now in what's going to happen the next 2 years. How much are governments going to jump in on this? How much are we going to see carbon pricing? And how is that going to impact the investments? And it is a big part. We do a scenario analysis on over 100 of our core portfolios. And we're looking at all of these different scenarios and how carbon is playing into it for each individual investment as part of that portfolio. And so there's, depending on the different scenarios, there are implications for the holdings in the fund. There's different vulnerabilities, there's different opportunities in it, but it's something we need to look at as asset managers. It's not easy. It's a massive undertaking to run scenario analysis like that on a quarterly basis. And also it's a massive undertaking for our investment teams to learn about what it means, because it's not the same in every region and it's not the same for all of our funds. We've got Canadian equity funds, we've got North American equity funds that have different vulnerabilities than some of our global equity funds do. And so yes, I guess my answer is, and I've sort of been a little bit long-winded about this, it depends on the region, depends on the fund, depends on the investment itself, but there's a real risk there that as asset managers, we need to be aware of and looking at our portfolios to see if we're factoring that in.
But you're talking about a lot of uncertainty because of, we don't know what the government regulation is, and Desiree was talking about it. So if you had to pick two things where you wanted clarity from governments that would enable you to sort of feel like you're making better informed investment decisions and not having to do all the scenario planning, what two things would you want clarity from government policy and regulation?
I would want to see clarity on what we want our corporate issuers and primarily corporate issuers to disclose in terms of ESG metrics. I want it out there, the material. I would like a materiality lens on it as well, so that we're looking at it on a sector by sector basis. I'd like to see that from governments. And, we're getting there now, but some clarity on, as asset managers, what would you like to see us put out there to the market? Because we're trying to be as transparent as we can. Are we missing anything that's important that should be disclosed? And so I think those are probably the two. There's probably a lot more. I mean, we will want to see TCFD disclosures. I think that falls under my first bucket of ESG metrics, consistent, material, sector-based metrics from the companies that we're invested in.
So I'm told we've got 2 minutes left. I'm under a lot of stress. I have to look at you people on a screen. I have to read a chat from these people giving me a hard time about the timing. I've got to read this what's up thing. So let me ask, one more question. Maybe we'll get to the last one. It's basically, how far does this divestment go? Like, do you divest from banks that are investing in fossil fuel companies? Maybe you want to kind of pick that up as if you believe in divesting. How far do you go?
I can't answer that because we believe in engagement, really. I mean, we really don't believe in divestment as a firm. We think we have a strong voice at the table when we're there talking to management and boards. We will offer some specific funds if clients do want divestment, but I wouldn't. For me, it's almost not at all on the scale of divesting. That engagement is the way to go.
So
I
let me
would
get
absolutely agree. One other point, Melanie, just to make is I think the asset management community has to also document and disclose. So I think, it's one thing to have a policy or shareholder letter. It's another thing to focus on outcomes and also report out on, what the corporate engagements has been. So I absolutely agree. But again, we need to be evidence data-based and we need to be outcome oriented.
So I'm told we're out of time, but I'm going to ask one more question. It's for you, Jason, because it was a good one that came in that basically is, what about the millions of people that don't have a direct way to express their views through like an engine number one? How are their voices heard? And Jason, you were talking about that. So people that care about it, that are individual investors, how do they mobilize?
It's a great question, and it's one that I think is ripe for entrepreneurial innovation, actually, to support individual shareholder engagement. I mean, engine number one does have an index fund you can buy. The ticker is VOT for vote. But other than that, there isn't much other than calling your investment manager and asking them for their stewardship policy, and asking for that kind of clarity from them.
Thanks. And I'll call Chris and tell him you gave his friend a little bit of a shout out. He'll be appreciative. So, lovely panel. Desiree, Melanie, Jason, good to see all of you. We'll end it here and turn it over to the next panel on impact and future and measure and all that kind of stuff. Thanks, guys. Cheers.
Thank you. Thank you.
Bye-bye.